Hello friends, so let's check out one more knowledgeable interesting video. In this video we're going to talk about conversion of firm LLP into company. What are those important sections? What are those important provisions that one need to keep in mind while converting firm LLP into company? We will going to concentrate our discussion importantly on two acts. First is Companies Act 2013 as well as Income Tax Act 1961. Today in this video I will going to share with you some important aspects of provisions of these two important laws. First is Companies Act 2013 and second is Income Tax Act 1961. So let's check what the Companies Act 2013 says about the conversion of LLP or firm into company. There are no provision under Companies Act. See, there are no provision under Companies Act 2013 regarding conversion of limited liability partnerships into company. But Ministry of Corporate Affairs MCA has passed a notification on 31st May 2016. In such notification, it's allowed conversion of LLP into company. These rules called the name of the rule is the Companies Authorized to Register Amendment Rules 2016. So this is important. You can take note of the said rules. The name of the rules are the Companies Authorized to Register Amendment Rules 2016. By taking side of these rules, one can convert its firm LLP into company. So the next important section of Income Tax Act 1961 is section 4713 clause 13. That section 47 clause 13 of Income Tax Act 1961 says that there is no capital gain tax on such conversion if the condition laid out in the said section 47 subsection 13 has been duly complied. If condition has been duly complied, then there will going to be no capital gain on the assets, on the net assets transferred by firm LLP to the company, and there will going to be no capital gain taxation liability on the firm or the LLP which has been converted. And the next important section here is in the conversion is section 72A subsection 6, which says that allowability of carry forward and set off of losses means accumulated losses and unabsorbed depreciation is allowed as per section 72A subsection 6. Means section 72A subsection 6 of Income Tax Act 1961 says that this section says that the accumulated losses and unabsorbed depreciation of the firm or the LLP will deemed to be the accumulated loss or unabsorbed depreciation of the company in which the firm or the LLP has been converted, right? So this is also one of the most important section of this Income Tax Act 1961 relating to conversion of firm LLP into company, section 72A subsection 6. So let's move on. Condition to be satisfied to avail the benefit of section 4713. What are those conditions that one need to satisfy to avail the benefit of section 47 subsection 13? There are some conditions which needs to be satisfied to get the benefit of section 4713. What section 4713 gives benefit? That section 4713 gives exemption relating to attract of capital gain on this conversion transaction, and there will going to be no capital gain when the firm or the LLP gets converted into company. So one need to satisfy these four given conditions to take benefit of section 47 clause 13. So let's check out what are these conditions. All business assets and liabilities of LLP firm are taken over by the company. It is a mandatory condition that all the business assets and all the business liabilities of the firm or LLP are mandatorily taken over by the company. No assets or no liabilities should be left apart in the firm or LLP itself. 100% of the business assets and 100% of the business liabilities should become assets and liabilities of the company. The partner of the firm or LLP do not receive any consideration, benefit in any form other than by way of allotment of shares in the company. It is mandatory that the consideration or the benefit which the partners of the firm or partners of the LLP are getting should be by way of allotment of shares only, and there should no consideration in any other form should be given by the company to the partners of firm or LLP. The partners of the firm or LLP should become shareholders in the company in the same proportion. This is very important. It has to be in the same proportion in which their capital account stood in the books of the firm on the date of conversion. The partners of the firm or LLP will naturally become shareholders in the company in the same proportion in which their capital accounts stood in the books on the date of conversion. And the last condition is the aggregate of shareholding in the company of the partners of the firm or LLP is not less than, it has to be not less than 50% of the total voting power in the company, and their shareholding continue to be as such for a period of 5 years. There is a period of 5 years lock-in that the holding should remain continue for a period of 5 years from the date of succession. So to get the benefit of section 47 clause 3, one need to satisfy these three conditions. Satisfaction of these three conditions is mandatory. If one wants to get the benefit of capital gain exemption, that there should be no capital gain on transfer of assets by firm or LLP to the company. Thank you. Thanks a lot for watching this video.